So I purchased a new stock. I now own 38 stocks in my dividend growth portfolio. The stock that I purchased, it's a master limited partnership called Cedar Fair, ticker symbol FUN, and it sure was fun. It was a lot of fun initiating a position in this company. As my subscribers know, I recently did a video on Cedar Fair. I will link in the description below. That was part 1 of 2. So today's video is part 2 of 2. And in that initial video, I just discussed the high-level aspects of Cedar Fair, what the company is about, why I like it, how it's fallen recently and is yielding almost 7%. And 7%, by the way, coming from a master limited partnership is even better than 7% coming through a typical qualified dividend, because master limited partnerships have some real tax advantages if one is used to dealing with K1s. Anyways, today's video is the next evolution in my journey with Cedar Fair. And I'm telling you, I agonized over this stock. I poured through the data. I spent so much time looking at the numbers. And in fact, I have a spreadsheet today. If you go to the description below, I'm also going to pin a comment. I will link to my email newsletter. And if you sign up for my email newsletter, you will receive a yield on cost worksheet that accompanies another video, and you will also receive the spreadsheets, my full financial analysis of Cedar Fair that accompanies this video. So these are my free gifts to all of you. And please keep in mind, you can unsubscribe from my newsletter at any time. And as I shared in my 10,000 subscriber video, I'll link to that in the description below, I am not here on YouTube or on the internet trying to sell a course or trying to sell people anything. And so you can sign up for my newsletter knowing that it's really just that. It's an extension of this community, of this PPC and YouTube channel. And like I said, you can unsubscribe at any time. Now, at some point in the future, I do have aspirations to write a book. So that is probably the only thing at some point in the future that I may advertise on this channel and to my email subscribers, as well as my book comes to fruition. But certainly no hard sales pitch here for a course or anything like that, because I view the free content here on my YouTube channel as the course. I want my best work to be here for everyone to see. And so today's video, it's just so exciting. I'm going to go through all of the big takeaways. All of these takeaways come from my financial model. And so one idea is you may want to pause the video here, or even while I'm talking, go to the description below, sign up so that you receive this spreadsheet, because having the spreadsheet open with the video will be very beneficial so that you can see some of these relevant points as I'm talking. And for those subscribers who have been here for a while, you know you've been asking for this forever. Ian, how do you analyze stocks? Ian, what's your spreadsheet look like? Well, finally, I am so thrilled to share at least one sample with all of you. And this one's a little different because we're dealing with a master limited partnership here. We're dealing with a real estate company. This is a bit different how I would analyze a consumer non-cyclical or another type of company, but that's good. Everyone's model, their framework, it tends to evolve per industry, and this is the evolution of how I look at master limited partnerships. And quite frankly, I'm newer to this industry, but I am not new to real estate. I know a lot about real estate, and so I applied a lot of the best practices that I have learned from real estate investing into my master limited partnership Excel spreadsheet and the model that I use to evaluate Cedar Fair. But anyways, let's get started. This is going to be a really, really exciting video. So I want to jump right into it. What did I find? What did I find in my journey just pouring through the numbers? And I'm telling you, I've been following this stock since the early 2000s. I finally went ahead and made a purchase, and I actually made more of a lump sum here. It's going to be a smaller position in my portfolio, but the reason that I made more of a lump sum versus average in is, one, it's tanked 30% from its peak. I'm locking in nearly a 7% starting dividend yield. And quite frankly, just to keep my records clean. With K1s, master limited partnerships, I don't want to have the mess of averaging in and have to reconcile all those records. I want my K1s to be really clean. And so with this particular company, I made actually two separate purchases, lump sums. I'm in it, and that's it. And I probably won't even reinvest the dividends from the standpoint that I just don't want to muddy the waters. I want to keep it real clean here from a K1 and a tax standpoint, make it easy on myself. But if I do buy more, I'll buy more of like a lump sum tranche than averaging in. So it's a little different than other stocks just because the K1 element is there. And so anyways, let's just get started. Revenue. You'll see in the spreadsheet, one of the first things I look at, I actually go all the way back to 2005 through 2017. And the way I do this is I go to the Cedar Fair website, I go to the Investor Relations website, and I pull annual reports. And I pull a few of them, and I'm able to extrapolate the numbers all the way back to 2005. So I do a lot of this brute force data entry work for the benefit of the community out there. But I do want to add the disclaimer that there's probably errors in this spreadsheet. I was going kind of quick on it, so maybe there's errors, maybe there's not, but just make the assumption that the spreadsheet probably has some mistakes in it, and always perform your own due diligence, double check, triple check everything. Maybe I'm even looking at it the wrong way, but I'm just sharing my journey today on how I looked at Cedar Fair. Anyways, revenue since 2005 is up 132%. That is fabulous. Now, this is not organic revenue growth. They made in 2006 this Paramount Parks acquisition. They acquired these Paramount Parks, including Great America, which is in San Jose in the Silicon Valley here. Prime piece of real estate. Love the fact that this is part of the company. That's why revenue is up, but it's great to see revenue up, and it's notching up pretty much every year. There might have been one or two down years, but other than that, it's just notching up. Really solid revenue growth, top line growth. I love it. Next, what I look at is debt. Being a real estate company, debt is part of it. Debt is part of real estate investments, whether one is investing in apartment buildings, shopping malls, anything, amusement parks. How are these real estate transactions financed? Typically through debt. And so they've got a bunch of debt. It actually looks pretty high. Talked about this a lot in my last video. There's two big refinancing events coming up. I think one was in like 2024 and one was in 2027. One of the risks is obviously if interest rates continue to go up when they refinance their debt, it's going to be at a higher interest rate, but time will tell. We will see. Probably will be. Fact of the matter, though, is one thing I always look at as a real estate investor is the cash flow. How well does the cash flow cover the debt? And so one of the things I spent a lot of time doing in my modeling is I backed into this cash flow metric. We'll talk about it in a minute. I had to hack it together. I didn't just pull this straight out of the annual reports. I took what they gave me and I hacked my way into an approximation of what the true cash flow is. Once I did that, I looked at the interest expense. Taking interest expense out of the true cash flow to look at true cash flow pre-interest expense, and then looking at that compared to the interest expense. In 2017 at least, the interest was covered over 3 times over, 339% covered. And so the fact of the matter here is these guys are fine even if their interest expense increases over time, in that the cash flow covers it. They're not going to have problems. And so what I concluded here is, to the average investor, myself included, when I just looked at this thing, debt seems high, and wow, it seems high even compared to some of their peers in relation to the scale of the business. But then when I really started pouring into cash flow and I look, is the debt covered? Is it covered just 1 time over? No. Is it covered 2 times over? No. It's covered more than 3 times over. And so obviously that was 2017. I show it for each year. It was less in 2016, but still it was up there. It's almost 300% coverage of the debt. And so this is really good debt coverage from my experience in the industry, in the real estate industry. And so I feel good about that when I really reconcile that. Something else. There were comments in my last video about Cedar Fair. I'll link in the description below. And people were saying, hey, they cut the distribution in the Great Recession. And it's true. They cut the distribution. And typically with dividend companies that I buy, a dividend cut or distribution cut is a deal breaker for me. However, it's not always a deal breaker. When it's not a deal breaker, and I've mentioned this before, is if it's very temporary in nature and steps are taken to resolve it right away. Well, I looked into this in great detail, and again, I backed into cash flow, true cash flow. We'll talk about this more in a minute, how I backed into it. But I looked, what's true cash flow per year over time? What are the distributions per year over time? And I looked at, the way I calculated what the true distributions are is I looked at the fully diluted share base and I multiplied by the distribution per share to get total distributions. You'll see this in my model. And I look, how do the two compare? Does cash flow, true cash flow cover distributions or not over time? And what's fascinating is during the Great Recession, the cash flow dips a bit, but the distributions dip so much more. They didn't, in other words, they didn't have to cut the distributions as much as they did. This company, I think, when the Great Recession hit, it was really bad timing because they acquired these Paramount parks in 2006. The Great Recession follows right after, and I think management was smart and took a conservative approach. They said, hey, we're just going to cut this distribution because this Great Recession here, this is scary stuff. We don't know what's going to happen. Banks are failing. Bad stuff is happening. We don't know how long it's going to last. We don't know what's going to happen. So we're going to preemptively cut this thing. We're going to cut this distribution for a few years here. We're going to wait it out and see what happens. And I think they did the right thing. And so I almost like the fact that they cut the distribution here. In fact, the distribution is up. When one can, it's actually up 2005 versus 2017. Distributions are up 89%. So it's grown quite a bit over that time period. But during the Great Recession, the distribution was cut. I don't think it was such a bad thing because these guys, again, the cash flow, the true cash flow that I calculated, it was doing fine during the Great Recession, dipped a bit, but they didn't have to do this. They didn't have to cut the distribution. They did it to be conservative. They did it to be conservative, to add a cushion, to give this company the flexibility that it needs to make it through that Great Recession, not knowing how long it would last, not knowing what was going to come and hit them. They are just being cautious. And being a real estate company, coming myself from the real estate industry, I can see what happened and I really respect it, quite frankly. I really respect it and I think they navigated this thing well. And I think, especially given that Paramount acquisition just happened, the Paramount parks. And so anyways, to me, the distribution cut was temporary in nature. It happens biggest in 2009, 10, and 11. But in my opinion, it's kind of a non-event in terms of, oh, should I not buy this company because they cut the distribution? I look at it another way. I bought this company because when I looked at why they cut it, I was encouraged. I was almost in awe of how well management navigated that challenging time and what they did being a real estate company and being tied to debt. Debt is part of the game when it comes to real estate. Real interesting, real interesting. And so that was conservative management, something I like to see. And so hats off to the management at Cedar Fair. Good job, guys. So let me go on here. One thing I noticed when I was just analyzing, one metric they report a lot of the time. By the way, I'm not covering all the metrics here. I have a lot more metrics in the spreadsheet. You guys will see. I hope you enjoy it. I'm just highlighting some of the big stuff that stood out to me here. One of the other ones was per capita spending. They analyze in-park per capita spending over time. When I compare 2005 versus 2017, over all that time, it's only up 26%. I think they're kind of touting this metric as a good metric. When I look at this, not knowing anything about the amusement park industry, that doesn't seem like that's up much at all. One of the challenges these guys are facing based on their most recent earnings report, and the earnings were lackluster, by the way, that's why the stock is down 30%. It's down because revenue is slowing, record year in 2017, revenue is slowing in 2018, but costs are up. Costs are up because minimum wage is rising. Everything's more expensive to operate now because of the rising minimum wage. If minimum wages are rising, their per capita spending better be going up faster than 26% from 2005 to 17. That's more than a decade's time. I'd like to see per capita in-park spending up more than that. That said, not captured in this metric, they get a lot of spending outside of the park. They own land, lots of land. I covered this in the last video. One of the reasons I like this company so much is they have lots of room for future development. And one of the things they've been doing is building hotels and developing areas outside of the park, and this metric doesn't capture out of the park spending. That said, in-park spending still, I'd like to see it up a bit more, so I don't know if they were touting it or not. It kind of seemed like they were. I don't really look at it as that good, but that said, I'm willing to live with that. What else did I find here? So here's just an important note. When one looks at a master limited partnership, similar to a REIT, a real estate investment trust, I've done a few videos on those, I'll link in the description below. The concept of earnings per share is pretty much worthless. Payout ratio, these traditional metrics that one looks at with like a consumer non-cyclical, they're worthless, and that's because of this concept of depreciation. In the real estate industry, one is able to depreciate their buildings, or in this case, their roller coasters, their improvements to the land that they've made. And there's a lot of depreciation here. I like that because it flows through to the unit holders on the K1, and unit holders are able to benefit from that depreciation. But anyways, in earnings per share, it looks at it actually factors depreciation out. So the earnings are post depreciation, but depreciation, it's not a real loss. Maybe it is a little bit for this company because they have to do a ton of capital expenditures to keep improving their parks. That said, I look at depreciation mainly as phantom income. And so because earnings per share is post-depreciation, it's just misleading. It doesn't show the true profitability, the true cash flow of the company. I'm going to get into a minute how I calculated the true cash flow. But when one looks at this, they're like, oh, the payout ratio is so high, it's so wacky, and the PE ratio, this and that. Those types of metrics, in my opinion, are pretty much worthless for this type of company. But that said, they do have to report it on their earnings because it's just a metric that is required, probably, if I had to guess, by SEC regulations to include that type of thing on the annual reports. Anyways, moving on. What is one to do to really understand how such a company is doing? Well, what I did is I really backed into cash flow. And the way that I did this is, thankfully, they report this metric called adjusted EBITDA. And what EBITDA stands for, if you've never heard this term before, it's earnings before interest, taxes, depreciation, and amortization. And so it also, in their adjusted EBITDA, they adjust all kinds of things like currency fluctuations between the US and Canada because they have a park in Canada. They adjust out like prepaid interest that they or prepaid capital or balance on their notes, on their debt. And so there's a bunch of stuff they adjust for, which is great. It's stuff that should all be adjusted. And so what I do is, I love this adjusted EBITDA. What I do is I kind of take that as my starting point, and then I say, okay, but the adjusted EBITDA, it goes too far. That's not the true cash flow because the adjusted EBITDA factors out the interest charge, and interest charge is real. The interest that they pay on this financing, this is real. And so what I do, first thing I do is I take adjusted EBITDA and I subtract out interest expense. It's a big expense, one of the biggest line items for this company being in the real estate industry. Next, what I do is they have taxes. There are real taxes. Most taxes here flow through to the shareholders because there's no double taxation here. There's no corporate taxation because this is a master limited partnership. It flows through to the limited partners on the K1s. But that said, at the corporate level or at the partnership level, my understanding here is they're paying the property taxes, and so there is a provision for taxes. That is factored out of adjusted EBITDA, but that's a real expense, so I subtract it out. So adjusted EBITDA goes down because of interest expense, goes down again because of those taxes. And then I also factor out CapEx. CapEx is a real expense for this company, a real line item. It's a big line item, it's expensive. And so I take adjusted EBITDA and I also subtract out capital expenditures. And capital expenditure, by the way, what that means is it's basically money that's set aside for them to fix roller coasters, to repaint buildings, to refurnish hotel rooms, to buy new roller coasters and install them, everything to keep the park going. And it's pretty big for this kind of company because they always have to keep the parks up to speed to fend off competition, just to make it a good experience. If someone's going to come back year and year again to one of their parks, it better have new and exciting attractions that keep up with the times. And so I take adjusted EBITDA, I factor all these things out. That's how I really approximate cash flow. You'll see in my spreadsheet how I do this. And what's interesting, Then I approximate cash flow and I compare that to distributions. Most of the time they pay out most of their cash flow as distributions, and they should be doing this because that's the structure they're in, the MLP structure. That's the purpose of the MLP structure, and it's also a sanity check. It's one way that I can prove to myself that I calculated cash flow with some accuracy. It's probably not perfect. I probably made some mistakes here, but it's close, it's directional. It's the fact that the distributions kind of line up with my cash flow. But what's interesting is when one goes back to the Great Recession, you start seeing that, hey, distributions were really cut here, but the cash flow didn't dip as much as the distributions would indicate. And again, it shows that conservative management. So if you're going to spend some time on this, again, disclaimer, this spreadsheet may have mistakes, but I really like this adjusted kind of cash flow metric that I pulled off of adjusted EBITDA and did a bit of hacking to get to it. I think that it's a really good metric, and it shows really what this company is about and how it weathered the storm during the financial crisis and how the adjusted cash flow is doing over time, or the approximation of cash flow. What else have I got here? Cap rate. In the real estate industry, there's this concept of net operating income. Net operating income is basically the amount of income that is being driven by this company, but it comes before the interest expense. It doesn't include interest expense. And net operating income, why it's really useful, is what a lot of people do with net operating income is they take what's called a cap rate. And a cap, you basically take the net operating income, you divide by the cap rate. It gives an approximation of the complete value of a real estate company. And so I kind of back into net operating income again. What I do is I take my cash flow metric, my approximation of cash flow, but I don't subtract, I add back the interest. I add the interest back. And the reason I add it back is because net operating income is before interest is paid. It's the profitability not taking interest into account. And so it's a higher amount of cash flow than would be in my true cash flow metric. Anyways, I take my approximation of NOI. You'll see that again in the spreadsheet. And I start just applying some cap rates to it. Here in the greater San Francisco Bay Area, if you were to buy an apartment building, a reasonably nice apartment building, the cap rate on something like that would be a 5. And what that means is one would take the net operating income and then they would divide by 5%. And that would give the overall value of the real estate project and how much it would trade hands for if someone were just to buy the building. When I look at this company, Cedar Fair, by contrast, the cap rate that's basically being applied to it right now is a 10. I have to take this approximation of net operating income that I found, that I backed into, and again, I might be making mistakes here, but more or less it's close, and it's approximation. And that's the thing, is I paint with broad brush strokes here. It doesn't have to be perfect. Take my approximation of NOI, I divide by a 10 cap, a 0.10, that gets you the current market cap. What I end up thinking is this really a 10 cap? A company that has been around for a long time, very diversified. It has 25 million visitors annually across their parks. It's a real estate business that attracts just a wide array of people. It's affordable. It applies to a lot of people. It's diversified in that sense. They have 13 parks. Is it really a 10 cap? I don't think it's a 10 cap. I just don't think it's a 10 cap. I think this thing has been punished. It's been punished bad because of the recent earnings report, and I love that. I love these buying opportunities because I've been waiting to buy this thing since the early 2000s. I totally missed it during the Great Recession because I wasn't looking at it right. I looked at the distribution cuts during the Great Recession, and I thought that was indicative of where the cash flow was going. I didn't take the time to do this analysis. If I had, and maybe I was a more sophisticated investor at that time, I would have clued in that, wow, hey, Ian, yeah, they cut the distributions, but the cash flow is actually doing okay. Buy this thing. Well, if I did, it would have been a different story because I would have been way up on this thing and have the best yield on cost I've ever experienced. That said, it happens. Next best thing is to find a buying opportunity like there is right now, in my humble opinion. And so I went for it. I bought it. And I bought it because I don't think it's a 10 cap. I think it's probably more like a 7 cap. And just if this thing trades back up from a 10 cap to a 7 cap, it implies that it's basically going to have about 43% upside here, 43% upside in the share price, or in the price of the limited partner units. And so I think there's a lot to like about this company here. Certainly there's downsides. I think the downsides obviously is the per capita spending going up enough. Maybe it could go up more. They got some debt and it's all going to be refinanced at once, and it's coming up in a while, and so by then interest rates could be higher. If they don't grow revenue, they don't grow cash flow quick enough, and these interest payments are much higher when they refinance debt, okay, we're going to have to taper off that distribution and cut it for a while, or for maybe a long while. And so that's something that I'm ready for, I'm prepared for. I'm willing to take that risk for this starting yield of 7%, almost 7%. And the fact that it comes with those tax efficiencies, being a master limited partnership structure. So hey, a technical video today, everyone. I know you've been waiting for it. I know I've been getting a lot of questions about this type of analysis over time. I'm really striving here on YouTube to provide value that is unique. And one of the things that I think a lot of people tend to do in the market is buy low, sell high, act on emotion. This is what real investing is. Real investing is digging into the numbers. And like I said, I agonized over this thing. This isn't all of it, but I sure spend a lot of time going through this thing. And it's funny, they manage a property. They don't own it, but they are manager of a property here in the Bay Area called Gilroy Gardens. It's more of like a kids theme park. And so can't wait to go there with my family and do some hands-on research of our new position in our portfolio. That'll be fun. And Great America is still on my list to do as well, but maybe when the kids get a bit older, just because those kind of rides aren't as beneficial or good for little kids. But we'll see. So a lot of fun ahead, and feel good about owning this company now that I've really done my analysis and I really understand it. And I'd be curious, what do you think about Cedar Fair? By the way, I compared this thing a bit to Six Flags. I know that one subscriber was asking about that. Thank you. Six Flags actually looks like a better company than I thought they would be. They've done real well over time. Lower dividend than these guys, corporate structure, similar industry. At the end of the day, the reason I like this better than Six Flags is I have a higher dividend, and it's this master limited partnership structure which affords some of those tax efficiencies, and they seem to me to be more shareholder focused in terms of getting the cash out to the shareholders. And I invest in a bunch of companies in my portfolio, 38 now. Some pay low dividends right now that grow quickly over time. Others pay high dividends like this that may or may not grow quickly. This one will probably grow slower. They're targeting about 4% per year, but I'm starting at 7. And so what's great about this is if I need to tap into cash flow tomorrow, I probably don't, but if I want to, this gives me some current cash flow in my portfolio. And as a portfolio as a whole, I don't really want to own too much real estate because I'm already pretty skewed in real estate based on the industry where I work, based on owning a REIT that I'll link in the description below. But I'm happy to add this as a smaller position in my portfolio. And I think the only thing worth mentioning before I close out today is I brought it to size pretty quickly. I just made more of a lump sum on this. It's a small size. It's not a medium or big in my portfolio, but I didn't average into this because, quite frankly, K1, more paperwork. When it comes to tax time, my accountant is probably, I don't remember how I'm charged on K1s, but I think they charge me for each individual K1. And so I'm adding a new K1 to the mix. I'm going to have to pay for that K1 to be processed. And so I just want to make sure this thing's bringing in more than enough cash flow from the beginning to compensate for those added headaches when the tax season comes. And so just something to think about for investors out there, the tax complications of having something that's a master limited partnership. Thank you for watching the video today. In terms of full disclosure, I am long. I own this company, Cedar Fair, ticker symbol FUN, in my personal stock portfolio. Also, in terms of a friendly disclaimer, this is not financial advice. I'm not a licensed financial advisor. This video is just for your fun and entertainment. I'm literally just here on YouTube sharing my personal journey. And like I said, the spreadsheet, the analysis, it was pretty complex on this one. Probably got some errors in there. And so certainly just sharing it for fun and entertainment. Before you go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Hey, we're almost here at 12,000 subscribers, so I'm really excited. I thank the community for your support. Truly means the world to me. And if you want to support this channel, the best way you can do so is subscribing, liking, commenting. All that means the world to me. I'm not going to be able to answer all comments right away because there's just so many coming in, but I do my best to get to all or most of them. I'll read all of them for sure. So please comment in the comment below in the comments section. And keep in mind, I've been getting also just a lot of like messages, like Facebook messages and stuff. Typically, I will only respond these days just because of the big influx of comments if they're public, because I want everyone to benefit from the conversation. So if it's more of like a private message, I'm not really monitoring those as closely just because I want to prioritize those questions and comments that are public, whether it's on YouTube or one of my other social channels as well, like Instagram, for example. I'll link in the description below to that. Get a lot of good public questions on Instagram. As long as they're public, I will do my best to answer because I want everyone to see and benefit from the knowledge that's being shared and the discussion that's happening. Thank you so much for watching. I would love to know what you all think about Cedar Fair, ticker symbol FUN, this fun small cap company, real small cap, under 3 billion market cap. Certainly a new type of industry diversification for my portfolio, having no prior exposure to this to this type of industry, this pure play amusement park company, and so really excited about that. I will see all of you in the next dividend investing video.